Good day to everybody. I am Nicolas, Bornozis, President of Capital Inc., and I am delighted to welcome you to today's Trending News podcast. We have with us today the founder and CEO of Tsakos Energy Navigation, Dr. Nikos Tsakos. And we will have the opportunity to discuss with him the tanker market trends, outlook, and the company's development. As we all know, TEN was founded in 1993 and is celebrating this year 32 years as a public company. It is one of the first and most established public shipping companies in the world. Now, TEN's diversified energy fleet currently consists of 82 tankers, 82 vessels, consisting of a mix of crude tankers, product tankers, LNG carriers, totaling about 10 million deadweight tons. The company's common shares are listed on the New York Stock Exchange under the ticker symbol TEN, T-E-N. Now, before we begin, I'd like to remind everybody of the usual disclaimer that this discussion is for informational and educational purposes only. It should not be considered as investment advice or advice of any kind, or an offer to buy or sell securities, and obviously Capital Inc. bears no responsibility for the content. And as a further disclaimer, we have the great privilege to work with Tsakos Energy Navigation on investor relations. Now, let me welcome our guest, Dr. Tsakos. And the company recently announced its earnings for the fourth quarter and for the full year of 2024. But above all, the company announced a transformational transaction, and that's what I would like to focus on and start our discussion with. Now, you recently announced a milestone transaction, the building of 9 DP2 shuttle tankers on long-term employment to Brazil's Transpetro, with expected contracted revenues of 2 billion over the next 15 years. Now, this positions TEN as one of the largest shuttle tank owners in the world, and your pro forma shuttle tanker fleet will be 16 vessels, all under fixed employment. So before we delve into the discussion, can you share with us a little bit about the characteristics of the shuttle tanker market? How does it work? How does it differ from the traditional crude oil or product tanker market?
Thank you, Nicolas. And, yes, in TEN we're very proud, and we try to have to offer specialized solutions to our clients whenever we can, and we have been able to do this through the years. Some years ago, we became the largest ice class operator in the world, and we still maintain a very large ice class fleet. Later, we have become the largest operator for Equinor, one of the most prestigious Scandinavian state oil companies. Last year, we became the largest operator of dual fuel vessels, which means ships that can burn normal conventional fuels, LNG or methanol. And earlier this month, we were awarded 9 shuttle tankers from the Brazilian state oil company Petrobras, the largest ever transaction for an independent shipping company to date. The shuttle tanker business, every business that we will discuss together with our conventional vessels have special features. The shuttle tanker business is tightly held, very specialized operations with highly trained crews in very difficult conditions. So it's to imagine those ships are of the suezmax capacity. They can actually go next to the drill ships all the way 200 or 300 miles into the oceans, and under difficult conditions be able to maintain stability and load the cargo straight from the oil rig. So, I mean, this is a very specialized procedure. I don't think there's more than a handful of companies in the world doing these operations, and we are currently the largest of that sort. And of course, complexity of the operations will result to better returns for our services.
So what these tankers do is they take the oil from the rig to the terminals on shore, and they go back and forth doing the loop.
Exactly. They have huge flexibility because there are conventional ships, although they have up to 16 azimuth stabilizers to be able to stay up to force 8 weathers and 6 to 7 feet waves next to the drill ships without creating any operational hazards or pollution, which is exactly what we haven't done for so many years. We have a clean record, and we've been operating in this field since 2012.
So now, with these new ships, you are going to have 16 in total, all of them under long-term employment, which means with very high quality counterparts, which means very long-term visibility of revenues and earnings. Now, let me ask you, why is this transaction transformational for TEN?
Well, first of all, we are in our conventional tankers. They participate in a relatively fragmented market environment. However, because of the company's reputation and operational performance, we are able, even on our conventional dry cargo, on our conventional crude and product carrier vessels, to be awarded long-term contracts. On the more specialized vessels, as I mentioned, ice class or the dual fuel vessels, and especially the shuttle tankers, it's a much less fragmented industry, and the cooperation between the end user and we as the operator is imminent. So
this is a big transaction. What is the capital outlay for this transaction, and how do you plan to finance it?
Well, we have been criticized that we always maintain a lot of cash. Last year we exceeded $500 million in cash. And of course, this gives us the flexibility to be able to move very quickly without having any fine subjects to finance in big transactions like this. Earlier in 2024, we purchased the Viking fleet, again, through a very fast cash transaction, and we were able to do the same. There were 22 other companies competing for this business, and for us, it was a first mover's advantage because we have the liquidity and the very strong balance sheet. And the vessels are going to be, they have been already really financed. We have already offers for the for 20 to 25 year old, 20 to 20 year cycles for the financing of our ships. So it will not really make a dent on our balance sheet. It will further strengthen because we're doubling the foreseeable receivables from 2 billion to 4 billion, having also increased by more than 30% the deadweight of our fleet.
So with the 16 shuttle tankers, you have positioned TEN to be one of the largest owners in this particular field. Is that a business that you can grow further? Is this particular market segment a growth area?
Very much so. And but again, it's not a business for the faint-hearted. It takes a very long time to educate and to get the licenses for the seafarers. It's special shuttle tanker seafarer license. It has not much to do. I mean, a normal cadet will have to spend at least 90 days at sea and 90 days in the academy to be able to start getting a license for those ships. We have the only accredited from the London Institute training center in our premises in Greece. And of course, this was obvious when we had 22 competitors, that we were the company that has had the longest experience in Brazilian waters from the peer group that we were competing, and a very good track record going forward. And I think more importantly, we didn't cut corners. We're building the ships like all of our shuttle tankers in South Korea. We had a lot of competitors coming with questionable quality ships from other countries like Vietnam, China, that were much cheaper. But of course, you cannot have such a sophisticated vessel as a guinea pig trial in so deep waters. So right now we are already building 3 similar sister vessels, 2 of them for Total Energy of France, and the third one for Action, all of them for very long tenor employments. So the continuity of building the 9 ships will come natural for us and our onshore and offshore personnel.
And in the current environment, industry experts expect the offshore drilling activity to intensify, and exactly having developed this particular expertise and dominance in the sector should be an advantage for you to grow it further.
It's true. So, I mean, since this transaction, we have been approached already by 2 major companies that are in the market for very similar 10 to 15-year employment for very similar ships. So I think we will be increasing this side of the business significantly.
So let me turn now to to today's geopolitical landscape and the tense competitive positioning in it. The US is a huge energy hub, and it's a main port of call for tanker owners or for anyone dealing in energy. So how is TEN positioned in the current environment, given the new administration's policies on port duties?
Well, I mean, we have been traditional partners with all the major oil companies in the United States. 22% of our business comes from ExxonMobil for 2024, and between Exxon and Chevron, we're closer to 35% of our freight hires come from the 2 American giant companies. So we are very used to trading in US waters. The modernity of our fleet, which has the vast majority, I think we only have 2 ships in the water that are not built in Korea and Japan, and those are dual fuel vessels. The majority of our fleet and the modernity of the fleet actually makes us a very big candidate for trading in the very demanding east and west coast of the United States. So the US is our biggest port of call. I believe that some restrictions can be taken to make sure that the vessels, for me, it has not much to do with where the vessels are being built, but if the ships are if they're environmentally and they have not cut corners when they were built to put the environment in disarray. So, you know, I think inspections have to be done on ships that are not built in the main strip yards and the tested yards to make sure that they are not threats for the environment.
But you have 82 ships in total. You mentioned that only 2 of them are those that are not built in Korea and in Japan. So it means 80 of them are built in Korean and Japanese yards. And you also mentioned about the modernity of your fleet, which has been always a competitive advantage of TEN. In this context, you have continued to upgrade your fleet with dual fuel and scrubber-fitted vessels. How are you approaching the energy transition from a commercial standpoint? Are you seeing client demand to evolve meaningfully around emission targets or fuel-efficient vessels?
Yes, and I think this is something we welcome. I mean, we are all here to make sure that the sea, and we live from the sea, and the environment are maintained. The sea is the roots, they are highways, and we want them clean for us and for the future generation. So we welcome every change that makes sense towards this direction. And that's why I said we are the largest operator dual fuel vessels. I'm happy to say that our seafarers right now have been accustomed to this very complicated changeover of bunkers on the ships. Some of our clients are only burning LNG, other clients are burning methanol, many of them depending on the scarcity of the bunkers, they can do both. So it is an ever-evolving environment towards the right target and the right goal. And I want to remind for those who I think are younger or have not focused that the tanker shipping in 1990, after the Exxon Valdez grounding and the pollution, the OPA 90 imposed the double design on ships, which was a vast change on the design of a ship. So you have to build a ship within a ship with a void space to avoid any spillages. This technology has worked for the last 25 years, and any spillages have been reduced by 99.9%. And the tanker owners took this initiative, they rebuilt the industry, not every single ship, all of a sudden, and we're talking about thousands of ships, became of double design. And the same is happening with the developments in the combustion part of the business.
So let me turn now to the broader tanker market trends and the trade disruptions. What is your outlook on the tanker market, given the demand-supply dynamics, and also taking into consideration the significant geopolitical tensions? How are you adjusting TEN's fleet deployment in this environment?
Well, I think in general, because of the reasons you have mentioned, the supply-demand equilibrium is positive. There's not that much supply. There's not enough supply because people or investors and ship owners do not know what type of vessel to build because of the environmental changes that might happen. And then your ship will have to suffer price reductions or perhaps non-conformity. So this has taken a lot of ordering out of the equation. On the other side, you mentioned geopolitical tensions. We're getting more ton miles because of the illogical attacks of terrorists to our ships in the Red Sea. I mean, I don't see how this is helping anybody to have innocent seafarers murdered, just providing such a significant service. And another part, again, that has to do with geopolitics, we are reaching a place where about 30% of the world fleet is what we call the gray fleet. It's a fleet that does not follow any rules, and it just trades wherever it wants to trade without adhering to any legislation, any sanctions, and any rules. So this is a part of the fleet that, of course, cannot participate in the mainstream day-to-day business. So the short answer is that right now there are more cargoes out there than ships that can carry them, and that's why we're seeing a healthy, fluctuating, but very healthy market. I mean, this week we saw the Mediterranean Aframax market going to up to $70,000 a day. The Black Sea market for suezmax is to $50,000 a day. So these are very, very healthy and sustainable levels.
Thank you. Now, let me move a little bit into the financial figures. Can you mention to us, you have strong liquidity, strong cash flow, you have very conservative leverage. Can you give us a little bit of those figures, and also what is the charter cover that you have right now?
Well, we call ourselves one-stop shipping because we build ships on what our clients, after our clients' requirements. And we do not focus on one side, so we have anything from VLCCs to shuttle tankers to small product carriers to dual fuel suezmaxes and to LNG. So whatever a client requires, we can provide. We have the expertise to provide for them. The modernity of our fleet allows us, we have right now 70% of the fleet is on long-term employments, 30% is in the spot market. However, out of this half, the 50%, I would say, of the contracted fleet enjoys profit-sharing arrangements, which allows us to participate also on the upside. We have always kept ample liquidity because you only appreciate the liquidity when you do not have it, and it's good to have it when opportunities arise. And we have proven this year after year after year. We get criticized that we always keep a little bit more cash than others do, but I think we have proven that we use it rightly and very quickly when we need to. We are perhaps one of the very few companies that we have never negotiated any loan, and that's why we enjoy very low spread. We are charged very low spreads by our banks, anywhere between 120 to 140 basis points above the old LIBOR, which, as they used to call it. And with all this, we have a fleet valuation, a fleet book value of about 3.1 billion, let's call it 3 billion. We have net debt of $1.5 billion. We have 4 billion of future earnings, secure future earnings. And we have 30 million shares outstanding. So if you do the very simple math and you deduct out of the 3.1 book value, and I have to say that our actually market value is significantly higher, closer to 4 billion from the book value. And if you deduct our 1.5 billion debt, our net asset value should be, without taking any consideration our future business, to $50 a share. We were at $30 or $32 a year ago. We're down for reasons that have nothing to do with our company, but because of the whole uncertainty and the geopolitical tensions to $17. So I think we are way undervalued. And of course, we as insiders will keep on always, we never sold the share, we always buy our shares. But of course, we don't want to stagnate all the liquidity from out there. But right now, I think 10 has been penalized together with the other shipping companies for the fluctuations. Although in 10 we have tried over the 32 years in operation to take as much the cyclicality fluctuations out of our results, and I think we have been successful. We've never stopped paying dividend. We have uninterrupted dividend. I think we have paid close to $900 million in dividend in the last 20 years, which is more than a dollar, over 30 million shares, and dividing by the years, almost $1 a year, and we're still trading at very low multiples. And I would say this is, as we speak today, this is our main concern, is to get 10 share price great again, as you would say.
Well, I had a question for you, why you think your share is undervalued, but I guess you answered it already in a very detailed fashion. Of course, if you put your NAV at 15, you're trading at 17 now.
Yeah, it's not that we put it, as you know, Nick. There's a very liquid and easy way to value ships, so it's much easier than real estate. And I mean, if you look in any of the large brokers, they come out with weekly publications of how much a new building is, VLCC, every single category we own, anything, a new building, a 5-year-old, a 10. So even someone with very little knowledge in shipping can sit down and value our fleet. Of course, this does not do justice to our fleet, because our fleet is not only cold still in the water, it turns money, very accretive rates for the next 10, 15 years. We do not get any credit for that, but we don't even get the full credit of the cold steel. So it's really frustrating that we are, in such a low valuation. It's not a 10 only issue. It's an industry issue. For us, because we know the real value of our company, as insiders, we do not spend too many years over it because we're not sellers and we know, but it's not fair to be valued at these minute levels where we should be at least double where we are.
Well, clearly the question of the value dislocation for shipping stocks, it's an industry-wide phenomenon. Actually, next week when we have our shipping forum in New York, we have a panel dedicated to that, because it really makes no sense, as you pointed out very eloquently, that not only you don't take credit for the huge investments you have made into infrastructure, and I've been in your office to see all the, the whole infrastructure you have built for cybersecurity, for operations and so on, but you're also valued below steel value. But that's an industry-wide phenomenon, and frankly, it makes no sense why shipping stocks should be valued that way. Let's hope, and now, of course, with the new transaction that you've made, you are putting TEN on a very different profile, because now your contracted earnings will grow significantly and for a much longer period of time. So that should create a different stability. So maybe investors are going to look at it in a different way.
Well, I mean, as I said, for us, it's not, we're not sellers. As insiders, we always buy our share. We know the value of our share. I think it's not fair, and we need to do as an industry and individually a better job explaining to the shareholders, because I do not think it's fair for the shareholders. I mean, there are people, of course, our share had a huge, we are victims of the big move we had from 3 to 30 in the last 3-4 years. So people said if a share can go, from 3 to 30 tenfold, it can be allowed to take a correction. But we were the $3 and that dollars was in the middle of COVID, where people, we didn't know if the world was ending, we didn't know if trade was ending, people were panicking. So it was not a logical situation to be. I think anything starting with a 3 starts to reflect somehow the value of the company. Anywhere we are now, it's very, very low.
So let's conclude with a question on capital allocation. You have already pointed out that TEN, since 2002, when you listed in the New York Stock Exchange, we have paid dividends every year, regardless of the market cycle. So how do you plan to approach capital allocation, take care of your shareholders, and how do you prioritize between debt repayment, growth plans, buybacks, dividends?
I mean, as I said, we are a company that we have never renegotiated, even in the hardest time, any of our debt payments. So I think this is our obligation, but we have a very comfortable debt structure that I would say it is easy. And I make sure that we never bet the farm even to do big deals. We always have enough liquidity to grow the company and go further. Don't forget, we've been, since you mentioned, since we went public in '93, we have been through the Asian crisis of '96. I think very few of the people on this podcast will remember that. Then, of course, we had the events of 9/11 that actually stagnated world trade for a very long period of time, with fear, followed by the 2008 financial crisis. That also from 2008 to 2012, you had a big shock in the whole infrastructure of the economy and the base of the economy. And as we were getting out of that, we got COVID, and in the middle of COVID, we got the Ukrainian invasion. And as we were getting used to that, we went, October 7th, and the results of that. So we've been in crisis mode, I guess, for all the 20s so far. And that's why we have to have a liquid company, strong, to be able to take advantage of opportunities coming out of the crisis, but also be able to weather the storms. And so, debt repayment is very important. Growth, we have enough money for us to grow is important. And dividend. I mean, we're the major shareholders, and dividend is very, very important for us. But we did buybacks when we were, we tried everything over the years. But buyback is more like a divorce. You pay someone to leave you. And because we like continuity, I'd rather pay our shareholders and thank them for being our shareholders and grow with us, rather than having to pay to do buybacks. Anyway, the liquidity of our company is not that big. If we start doing buybacks very soon, there will not be any liquidity left. So, as I said, this is our priority: is reducing debt, growing our company, and then rewarding with dividends.
Actually, you made very well the point in your latest presentation that keeping this ample liquidity enables you to move fast for this transaction, and that's one of the competitive advantages. So being liquid is clearly a big plus. Anyway, I think we have reached the end of our discussion. I'd like to thank you, Dr. Tsakos, very much for being with us today. We had the opportunity to discuss with Dr. Nikos Tsakos, the founder and CEO of TEN, Tsakos Energy Navigation, who shared his insight on the tanker market trends, the industry outlook, and above all, on this transformational transaction that TEN successfully concluded. Thank you very much for being with us. And as a reminder, this webinar will be available for replay on Capital Link YouTube channel and also on capitalinkwebinars.com. Thank you, everybody.